In the 1930s, John Maynard Keynes watched the world collapse. Banks failed, factories went silent, men who had worked their entire lives stood in bread lines like criminals. And Keynes said something that sounded almost immoral at the time. Spend. Borrow. Let the government do what households can't. Because when the private economy freezes, waiting for discipline isn't virtue, it's surrender. And for that, Keynes was right. But there's a danger Keynes didn't see. Not in his math, in his faith. Here's the tension that defines modern life. We used Keynes to survive emergencies, and then we built a system that treats emergencies as the normal state of the world. The result is not prosperity, it's dependency. Debt that never gets paid, inflation that arrives unexpectedly, and governments that can't stop spending because the moment they try, the entire economy starts shaking. That's the danger Keynes didn't see. Keynes is often summarized with a slogan, "Government spending fixes recessions." That's incomplete. Keynes didn't say spend forever. He said spend countercyclically. Think of it like breathing. Inhale when the economy exhales. Exhale when the economy inhales. In bad times, when private spending collapses, the government borrows and spends to replace that collapsed demand. Why? Because if everyone stops spending at the same time, you get a death spiral. Factories close. Workers are laid off. Those workers stop spending. More factories close. More layoffs. It's a cascade. Government borrowing breaks that cascade. It says, we'll maintain demand while the private sector recovers. In good times, when the private sector is booming, the government runs surpluses, pays down debt, rebuilds fiscal capacity, and gets out of the way. Why? Because when private demand is strong, government spending becomes redundant at best, inflationary at worst. So the government should use the good times to save, to repair the balance sheet, to rebuild ammunition for the next crisis. In other words, Keynes designed an emergency brake, a temporary tool for temporary problems. He assumed you'd release it once the emergency ended. Modern governments pulled the brake and then welded it in place. And that's where the danger begins. There's an uncomfortable truth about deficit spending. It works, at least in the short run, which means it creates a temptation no politician can resist. Let me explain the political economy here. Imagine you're a politician running for re-election. You can, option A, cut spending and raise taxes to pay down debt. This is prudent. It's responsible. It's also deeply unpopular. People lose programs. People lose money. They vote you out. Option B, keep spending, maintain low taxes, let the debt grow slowly. People keep their programs. They keep their money. They feel happy. They re-elect you. The costs of option B don't arrive during your administration. They arrive 10 years later, when the next politician is in charge. So which option do politicians choose? Obviously, option B. And this isn't because politicians are evil or incompetent, it's because the incentive structure is broken. The benefit of spending is immediate and visible. The cost is delayed and diffuse. Keynes assumed a political culture that would do the hard thing later. Raise taxes, cut spending, save during booms, accept recession rather than print money, and then spend during busts. But he was wrong about democratic politics. Or at least, he was wrong about democracies across decades. Maybe, for a moment, a country can do the responsible thing. But sustain it for 50 years? That requires a level of civic virtue that democracies don't maintain. The structural bias of democratic politics is, it rewards the immediate benefit and punishes the delayed cost. So the temporary Keynesian fix becomes permanent policy. Interest on the debt becomes a growing share of the budget, and the government loses the fiscal space to respond to new crises. And the bill doesn't arrive as a single invoice. It doesn't announce itself clearly. It arrives as a slow poisoning, inflation creeping upward, currency debasement nobody can quite prove, asset bubbles that feel normal until they explode. stock markets soaring while wages stagnate, real estate becoming unaffordable, and a society that can't tell whether it's getting richer or just getting more expensive. Before I get into Britain, let me be clear about something. The post-war world was chaotic. Britain had fought for 6 years. Infrastructure was damaged, empire was cracking, and suddenly the entire economic order had to rebuild. This wasn't a normal recession. This was a civilizational reset. So yes, spending made sense. But the question Keynes asked was simple. Once you're rebuilt, do you pay back what you borrowed, or do you live with it? After World War II, Britain had a problem that makes today look modest. Debt was massive, over 240% of GDP. Infrastructure was damaged. The empire was fragmenting. And suddenly, the government needed to deliver a welfare state while managing a wartime debt load. Keynes himself had advised Britain during the war. He knew the situation intimately. And he was clear about the post-war rule. Pay it down when peace returns. Because war spending is a necessity. You spend to survive. But once you survive, you have a responsibility to restore fiscal health. Because permanent war spending in peacetime is a path to decay. It crowds out private investment. It becomes a fixed obligation that grows with inflation. It limits government's ability to respond to new crises. It's a trap. But what happened? Britain didn't really pay it down. It managed it. It rolled it. It inflated it. It lived with permanently high state involvement in the economy. Controls on prices, controls on wages, controls on foreign exchange. And over the following decades, Britain's relative economic position weakened. Not because Keynesian stimulus in 1945 was wrong, but because the emergency never really ended. The state never really withdrew. The controls never really lifted. And Britain slowly became less competitive while other nations recovered and modernized. This isn't because Keynesian ideas are evil. It's because the second half of the Keynesian program, discipline during good times, fiscal surpluses, paying down debt, was politically unachievable. Keynes built a system that required virtue. Politics supplied temptation, and over 50 years, temptation won. If you want to understand the modern Keynesian trap, look at America across 3 moments. The system was collapsing. Credit froze overnight. Banks were failing. Insurance companies were collapsing. The mortgage market had blown up. The fear wasn't a recession. It was a total breakdown of the financial system. So the government stepped in. The Fed cut rates to 0. The Treasury borrowed. Congress passed stimulus. And then came quantitative easing, QE. The central bank literally created money to buy assets, push down yields, and keep the system alive. Bonds, mortgages, whatever it took. In the moment, it worked. The patient didn't die. The system stabilized, credit thawed, and gradually, confidence returned. The Fed never fully returned to normal. The balance sheet stayed inflated, rates stayed low, and markets adapted to the new reality. They didn't just enjoy cheap money, they required it. Financial markets re-optimized around 0 rates. Asset prices recalibrated. Pension funds had to reach for riskier returns. Companies could borrow freely. Everything in the economy moved to expect that cheap money. So when the Fed tried to normalize, raise rates, shrink the balance sheet, markets panicked because the entire structure had been built on permanent, cheap money. Another emergency arrived. But this time, something had changed. In 2008, stimulus was shocking. By 2020, it was expected. The playbook was known, and the limits to that playbook were gone. So we did it again, but bigger. Trillions of dollars. Direct checks to households. Expanded unemployment benefits. Massive fiscal packages for businesses. Eviction moratoriums. Loan forgiveness. And QE returned at scale, even larger than 2008. The Fed bought corporate bonds for the first time. It created facilities to lend to small businesses. Again, in the short term, it prevented collapse. People stayed home. They didn't die of starvation. The system didn't crack. From a public health perspective, this was perhaps necessary. But economically, what had we done? We doubled down. We'd proven that any economic problem, health crisis, financial crisis, whatever, would be met with unlimited spending and printing. And markets learned that lesson perfectly. Why would you save? Why would you be prudent? The government will always step in. Then came the consequence. Prices surged. Not in a neat academic way, in a way ordinary people could feel. Groceries, gas, rent. Suddenly, inflation wasn't a statistic, it was a tax. And what did we hear? It's transitory. It's supply chains. It's corporate greed. Some of those factors mattered, but the deeper cause was simpler. If you treat money creation as a permanent tool, it stops being an emergency measure. It becomes a regime, and regimes have consequences. Keynes didn't design a regime. We did. Most developed countries get the bill slowly. Argentina got it quickly. Argentina is what happens when fiscal stimulus becomes cultural identity. Spending is how the government proves it cares. Printing is how the government avoids admitting limits. And inflation becomes a background noise people learn to live with. Until they can't. The currency weakens, savings die, trust collapses, and the entire society becomes obsessed with escaping into dollars, into assets, into anything that can't be inflated away. Now, Argentina is an extreme case, but it reveals the same pattern. The spending part is politically easy. The discipline part is politically impossible. So stimulus becomes permanent, and permanent stimulus becomes inflation, and inflation becomes social breakdown. Here's the most dangerous misunderstanding about economics. People think the argument is about math, numbers, equations, modeling. But the real argument, the deep argument, is about incentives. What behavior does a system reward? What behavior does it punish? Keynes designed a system based on assumptions. He assumed that elected governments would 1. Spend in recessions, boost demand when the private sector fails. 2. Save in expansions, rebuild balance sheets when private sector is strong. This is perfectly logical. It's virtuous. It's also politically impossible, because modern governments behave differently. 1. Spend in recessions. Obviously, this is necessary. 2. Spend in expansions. This is politically profitable. Why does this happen? Because spending has a visible, immediate benefit. A bridge gets built. Unemployment benefits expand. A business loan gets approved. People get checks. They can buy food, pay rent, support their families. The public sees the benefit. They feel the benefit. And they vote for leaders who deliver benefits. But the costs? The costs are invisible, at least in the short run. Debt spreads the pain into the future. Inflation spreads it diffusely across everyone. A little bit higher prices on everything. Your purchasing power erodes 3% per year. That's easy to miss. That's easy to blame on corporate greed or supply chains. And complexity hides it behind technical language. Quantitative easing, core inflation, real wages. So the public experiences a strange illusion. They feel like they're receiving benefits for free. Stimulus checks, unemployment payments, loan forgiveness. All of it feels like generosity, until suddenly it isn't. Until they go to the grocery store and a gallon of milk costs 40% more than it did 18 months ago. Until rent has doubled in 5 years. Until their savings are worth 20% less in purchasing power. Then the illusion breaks. But by then, the government is already addicted to stimulus, and the only way out feels like crashing the economy. That's the danger. Not Keynes, but Keynes in the hands of human nature. Look around the current world. Central banks raise rates to fight inflation, but higher rates make the debt more expensive. Governments feel squeezed. Households feel squeezed. Businesses feel squeezed. So what's the temptation? Spend again. Stimulate again, because the system has been trained to expect it. And then you get the trap. Spend to avoid recession, create inflation. Raise rates to fight inflation, make debt harder to service, spend to avoid recession. A loop, a policy addiction. An addiction is always the same story. At first, it feels like relief. Then it becomes necessity. Then it becomes destruction. Keynes was not stupid. He was not blind. He was one of the sharpest minds of the 20th century. He revolutionized how we think about aggregate demand. He gave governments tools they didn't have before. He probably saved millions of lives by preventing the total collapse of the 1930s from repeating itself. But he made one assumption that turns out to be fatal. He assumed the state could act like a wise adult, that it could restrain itself, that it would save in good times, that it would accept the pain of paying back what it borrowed, that democratic politics could sustain fiscal discipline across multiple election cycles, that public choice, the incentives facing politicians, wouldn't override economic logic. In other words, Keynes assumed a level of political responsibility that doesn't exist. Not consistently, not at scale, not over decades. And he wasn't naive about everything. He understood power. He understood markets. He understood crises. But he fundamentally underestimated how hard it would be to turn off the stimulus machine once it was built. And once that assumption fails, the whole system changes. Emergency policy becomes permanent reality. Fiscal prudence becomes political suicide. And economies adapt to expect rescue whenever things get hard. So here's the question. Keynesian tools can save you during a crisis, but can a democracy use those tools forever without turning the economy into a debt machine? Can democratic politics ever choose surpluses in good times, or is the logic of elections too strong? If Keynesianism requires discipline to work, and discipline is politically impossible, then what we call modern economic management might just be a slow-motion collapse. So I'll ask you, do you think democracy and Keynesianism can coexist long-term without collapsing into debt? Or is the danger built into the incentives from the beginning?